Welcome back to another deep dive. We are currently sitting in the year 2026. And I think it's safe to say the whole concept of, making money while you sleep has never been more aggressively marketed to people.
Oh, absolutely. It's everywhere.
Right. Like you open any social media feed and you are immediately bombarded with that same imagery. The laptop sitting on the beach, the automated deposit notifications popping up on the phone screen.
Yeah, the classic pina colada portfolio.
Exactly. But here's the reality, and it's actually pretty grim. Statistically, we are watching everyday retail investors just bleed their principal at totally unprecedented rates. And it's all because they are chasing this ghost of passive yield. I mean, the machinery required to actually build those income streams has grown exponentially complex over the last few years.
It really has.
Hmm.
And, it is arguably the defining financial paradox of our current decade. Well, the tools to generate yield have literally never been more accessible. You can buy fractional real estate from your phone on the train, but, and this is the big but, the underlying risks have never been more obfuscated. They hide behind these slick, gamified platform interfaces. So we're operating in an environment where the line between a robust, hands-off asset and a highly leveraged trap is incredibly thin.
Incredibly thin. So that is our mission for this deep dive. We're taking a sledgehammer to the heavily sanitized, get-rich-quick narratives surrounding passive income. We want to deconstruct the actual mechanics of what's available to you, the listener, right now.
And we're going to cover the whole spectrum today.
Yeah, from seemingly mundane cash instruments to the absolute fringe of decentralized finance and alternative assets. To do this, we pulled a really diverse stack of financial journalism and data. We're looking at reports from CBS News and Bankrate, educational material from Coursera, insights from global investment platforms like Mintos and Lender Market.
We've also got real estate data from CRE Daily and Per Annum, plus wealth advisory notes from Equentis and our EEP Equity.
Right, it's a massive stack. And we need to look at the exact trade-offs here between liquidity, risk-adjusted returns, and this is the one everyone ignores, the actual reality of your own time capital.
Time capital is huge.
Yeah.
But to kind of set the baseline here,
Yeah.
I think we should look at how the IRS actually views this concept.
Okay, yeah. Why the IRS?
Because the regulatory framework strips away all the marketing gloss. There's no laptops on the beach in the tax code. As highlighted in some recent coursework from Coursera, the IRS strictly defines passive income through this lens of, well, they call it material participation.
Material participation. Okay, unpack that for us.
Basically, if you are materially participating in a trade or business on a regular, continuous, and substantial basis, so, actively doing things, the income is active, it's just a job, true passive income fundamentally isolates your capital or your asset from your labor. It essentially only covers trade activities where you are completely hands-off or rental activities.
I want to pause on that distinction right there because it highlights the single biggest psychological trap that investors fall into. We constantly hear people conflate the word passive with effortless.
Oh, yeah. Constantly.
And it's just not true. I like to think of passive income like planting an orchard. You have to do backbreaking work up front. You're testing the soil, you're planting the seeds, you're digging trenches for the irrigation. It's exhausting. But eventually, once the trees mature, you're really just walking out back to pick the apples.
That's a great analogy. And it aligns perfectly with the commentary from Tal Tresidder. He's a former hedge fund manager that Bankrate profiled in their piece.
Right, I remember that quote.
Yeah, he is adamant that this idea of getting something for nothing is the foundational myth we just have to discard completely. True passive income requires a massive concentration of upfront friction. You are essentially compressing years of labor or a massive amount of capital accumulation into the front end of the timeline.
Specifically so the asset can carry the kinetic energy forward without you having to push it anymore.
Exactly. It's a transfer of energy. You build an infrastructure that eventually achieves self-sustaining momentum. But, and this is crucial for you listening, the architecture of that infrastructure dictates your risk.
Right. So before we start planting complex digital or real estate orchards, let's look at the absolute easiest place to start, the most conservative architecture possible. Because before anyone starts, leveraging into real estate syndications or staking crypto...
Please don't start there.
Yeah, please don't. We have to address the opportunity cost of the cash you already have sitting in the bank. For the listener who is highly risk-averse or maybe just parking a 6-month emergency fund, the traditional high-yield accounts are basically the gateway to passive income.
They are. And if we pull the recent analysis from CBS News regarding the 2026 landscape, we can actually see the exact mathematical reality of capital preservation right now.
Let's get into the numbers.
Okay, so they ran a projection on a standard $5,000 deposit over a 9-month horizon, just assuming static rates for a second. A high-yield savings account, a HYSA, sitting at 4.09%, generates roughly $152.60.
Okay, $152.
Right. Now, if you pivot to a standard money market account yielding an even 4.0%, that exact same capital produces $149.26 over those 9 months.
Okay, wait. I am going to push back on the utility of even running that comparison.
Really? Why?
Because look at the numbers. We are talking about a grand total difference of $3.34 over 3/4 of a year. I mean, when factoring in the broader macroeconomic environment, why should the listener even care about a spread that doesn't even buy a cup of coffee anymore?
I get that. But the spread itself isn't the point.
Then what is?
It represents the cost of the liquidity premium. The reason an investor willingly sacrifices that yield, however marginal that $3 is, to hold a money market account, is because of the embedded transactional utility.
Like check writing.
Exactly. You maintain check writing features and often debit card access. So in an environment where emergency liquidity might be required instantly, say, I don't know, to cover a sudden margin call or a real estate repair, that fractional reduction in yield is literally the insurance premium you pay to have immediate access to your capital.
Okay, that makes sense. You're buying flexibility. But let's look at the actual yield itself for a second. A 4% return right now feels, decent historically speaking, but we are completely at the mercy of the Fed's prevailing winds.
Oh, 100%.
We've seen consecutive rate cuts recently triggered by drops in inflation, and as the Fed funds rate drops, the banks immediately compress the yield on these accounts. So your quote-unquote passive income stream is actually highly dynamic. It's completely outside your control.
That is the variable rate risk inherent to cash. And CBS News rightly points out the inverse scenario, too. If we see market conditions worsen or resurgence in inflationary pressure, the Fed might be forced into a hawkish reversal. In that case, those yields will climb.
Right, your earnings would actually go up.
But you always have to contextualize that 4% yield. Yes, these are protected by FDIC insurance. Bankrate continuously emphasizes this. Your nominal principal is protected up to $250,000.
So you won't lose the $5,000.
Exactly. But the real risk here isn't nominal loss. It's purchasing power degradation. I mean, if your after-tax yield on that account is 3% and real inflation is running at 3.5%, your cash is slowly bleeding to death safely inside a vault.
That's a terrifying way to put it, but it's true. Which forces the investor out on the risk curve. To actually outpace inflation and build generational wealth, you have to move your money out of the bank and into the markets. So let's look at the traditional financial markets next, specifically the set-it-and-forget-it structures.
Moving up the ladder. So the foundational play here, and this is heavily cited across Acuentis, Mintos, and Bankrate, is the dividend-paying blue-chip equity.
The classic dividend stock.
Right. And the mechanics are really straightforward. You have these mature, large-cap companies. They've basically saturated their growth potential, so they don't need to deploy all their free cash flow into research and development or massive expansions anymore.
Because they already own the market.
Exactly.
Yeah.
So the most efficient use of their capital is just to return a portion of their profits to the shareholder, usually on a quarterly basis.
But I want to jump in and warn against something here because it's the classic retail investor error. Do not just blindly sort a stock screener by highest dividend yield and hit buy.
Oh, the dividend trap.
Yeah.
Yeah.
A massive yield is often a massive red flag. We see these companies sporting like 10% or 12% dividend yields, and investors think they've found the holy grail of passive income. But in reality, the yield is only mathematically high because the denominator, the stock price itself, has completely collapsed.
You're absolutely right. I mean, if a company is paying out a 12% yield, but their payout ratio, which is the percentage of their earnings they're distributing, is sitting at, say, 150%.
Wait, paying out 150% of their earnings?
Yes, meaning they are literally borrowing money just to pay the dividend to keep investors from fleeing. It is completely unsustainable. A dividend cut is basically imminent. And once that cut is announced to the public, the underlying stock price craters, and you suffer a massive capital loss that wipes out years of whatever passive income you collected.
Which is brutal. So how do we mitigate that single stock risk? Because picking individual companies sounds like a full-time job.
It is. So the sources point toward the automation of systematic investment plans, or SIPs. You layer these into diversified dividend mutual funds.
Okay, so you're buying a basket of stocks.
Right. When you utilize a TATA P into a broad dividend fund, you are mechanizing the discipline of dollar cost averaging.
Yeah.
You are systematically buying a vetted basket of dividend-paying equities every month, totally regardless of market sentiment. But the real engine of this strategy is the DRIP.
The dividend reinvestment plan.
Exactly. By automatically using those quarterly dividends to purchase fractional shares of the fund, you accelerate the compounding curve. You aren't just earning yield on your initial principal, you are constantly increasing your share count, which then increases your next dividend payout, which buys even more shares.
It's a snowball effect.
Yeah, it creates this geometric progression of income over a long time horizon.
I love the DRP strategy. But let's shift from the equity side to the debt side for a second. Because while stocks offer growth, they obviously introduce volatility. Bonds are supposed to be the ballast in your portfolio. Bankrate provides this really deep analysis on bond ladders, but I have to say, in a fluctuating rate environment, holding fixed income feels incredibly precarious.
Well, it is precarious if you don't manage your duration risk. Let's look at the mechanics of why a bond ladder is absolutely necessary.
Okay.
Let's say you take your entire capital allocation and you lock it into a single 10-year bond paying 5%. You're exposing yourself to massive reinvestment risk and opportunity costs.
Because you're locked in.
Right. If interest rates climb to 7% 2 years later, you are trapped in a suboptimal yield for another 8 years. And furthermore, the secondary market value of your 5% bond has plummeted, because no one wants to buy your 5% yield when they can just get 7% from a brand new issuance.
Right. So a bond ladder is basically like building a staircase. Each step is a guaranteed payday, and it ensures you never fall, even if the market shifts.
That's the perfect way to visualize it. It actively mitigates that duration trap. By staggering the maturities, so buying a 1-year, a 3-year, a 5-year, and a 7-year bond all simultaneously, you create continuous liquidity events.
Oh, I see.
Yeah, when the 1-year bond matures, you take that principal and you roll it into a new long-term bond at the back of the ladder, capturing whatever the prevailing rate is at that exact time. You're constantly smoothing out the interest rate curve, and you guarantee that a portion of your capital is always freeing up to be redeployed.
Okay, I understand the defensive nature of a standard treasury or corporate ladder, but the sources also brought up something far more aggressive and frankly kind of scary. Municipal bond closed-end funds.
Ah, yes.
Bankrate notes these vehicles are really sought after because the income generated from funding public infrastructure is generally tax-exempt at the federal level, which sounds amazing, but a closed-end fund operates entirely differently than an open-end mutual fund. We need to dissect the leverage here because this is where passive income seekers just get slaughtered.
It is a critical mechanical distinction. So a closed-end fund raises a fixed amount of capital through an IPO, and then it trades on an exchange just like a stock. But to juice that tax-free yield to attract retail investors, the fund managers utilize leverage.
Meaning borrowed money.
Exactly. They borrow short-term capital at lower institutional interest rates, and they use that borrowed money to buy more long-term municipal bonds that pay higher rates. They are capturing the spread between the short-term borrowing cost and the long-term yield.
Which works beautifully when the yield curve is normal.
Right.
Sure.
But what happens when the yield curve inverts, which we have seen happen with brutal frequency in recent macro cycles?
That's when the entire strategy unravels. When short-term borrowing costs spike above the yield of the long-term municipal bonds they hold, the fund experiences negative carry.
Meaning they're losing money every day.
Yes, they're bleeding money just to maintain the leverage. And because they are highly leveraged, the net asset value, the NAV of the fund, collapses far faster than a standard bond portfolio. The managers are eventually forced to slash the dividend payout just to survive.
So your reliable, tax-free, passive income gets cut in half, right, as the underlying value of your investment is plummeting.
Exactly. It is a highly volatile vehicle masquerading as a conservative income play.
Man, and that perfectly illustrates why so many investors eventually just suffer fatigue from the digital abstraction of the financial markets. It is incredibly stressful to watch your yield dictated by, the esoteric movements of the Fed funds rate or the NAV decay of some leveraged fund you barely understand.
It's exhausting.
Which inevitably drives capital toward hard assets, stuff you can touch. Which brings us to real estate. Per Annum points out this remains the most historically proven asset class for wealth generation.
Without a doubt.
But calling physical real estate passive borders on fraudulent unless we strictly define the operational mechanics.
Yeah. Calling it passive is a stretch. Per Annum correctly categorizes the varied avenues here. You've got long-term residential, student co-living, commercial properties, short-stay holiday rentals. But the overarching reality of direct ownership is that it is a highly capital-intensive, operationally demanding business.
Very active.
The foundational metric here isn't just gross rent. It is understanding how operating leverage works within the net rental income formula.
Let's break that math down for the listener. Because the gross rent illusion traps a lot of first-time landlords. You see a property renting for $3,000 a month and your mortgage is $2,000. You automatically assume, boom, I have $1,000 of passive cash flow.
And that is the fastest way to face insolvency. True net rental income requires you to subtract a relentless cascade of carrying costs.
Relentless is the right word.
Right. Beyond the principal and interest of your debt, or the EMI, you have to account for property taxes, which are subject to random municipal reassessments. You have structural maintenance, CapEx reserves for when the roof caves in or the HVAC dies, property management fees, and the silent killer of yield, vacancy loss.
Oh, vacancy is brutal.
If you do not underwrite a conservative vacancy rate into your initial projections, a single tenant turnover that lasts 2 months will completely wipe out an entire year's worth of projected cash flow. You are essentially losing money.
And wait, if we are strictly talking about passive income here, which is the point of this deep dive, so self-management is completely off the table. I mean, taking a frantic phone call about a leaky roof at 2 a.m. or dealing with a tenant who won't pay, how on earth is that passive?
It's not. It's property management, which is why, to make it truly passive, you are forced to hire a professional property management firm. And they typically eat 8 to 10% of your gross rents right off the top.
Ouch.
Furthermore, making it passive requires intense legal infrastructure on the front end. You need ironclad lease agreements. You need lock-in periods, aggressive late fee schedules, and automatic rent escalation clauses tied to inflation to ensure your margins don't erode. Basically, you are trading a significant portion of your yield to the property manager just to buy back your time.
But even beyond the management headache, the capital barrier to entry for direct ownership is literally locking out an entire generation of investors. If you want to acquire a stabilized commercial asset or a multifamily property in 2026, you need massive liquidity, hundreds of thousands of dollars.
At a minimum.
Right. And this friction has catalyzed what is arguably the most significant structural shift we've seen across all the sources today: the fractionalization of real estate. CRE Daily highlights that the global real estate crowdfunding market is on a trajectory to hit a 45.9% compound annual growth rate by 2030.
That is explosive growth.
It's insane. So we have to examine how these platforms are slicing up the capital stack for the average person.
The innovation here is profound, really, because it democratizes access to institutional-grade assets. But, listen closely, the risk profile shifts entirely from the physical asset itself to the platform sponsor.
What do you mean by that?
Well, let's look at the specific platforms available to the listener. At the true beginner level, you have platforms like Fundrise. They require virtually no capital minimums or as low as $10.
$10? Wow.
Yeah, and it's open to non-accredited investors. They basically pool this micro capital into private REITs focusing on residential and commercial developments.
Okay, that's the entry level. Then you have platforms like Arrived. Now, Arrived pivots away from commercial development into the hyper-specific niche of single-family rentals and vacation homes. You are essentially buying a fractional share of a specific house. And fun fact, they're actually backed by Jeff Bezos.
Right, which adds a lot of marketing credibility.
Exactly. The minimum there is $100.
Okay.
But I was looking at their fee structure in the source material, and it requires some really aggressive scrutiny. They take a sourcing fee of around 3.5% right off your initial investment, plus an ongoing 0.15% quarterly assets under management fee.
Which really eats into your returns.
Yeah. That 3.5% sourcing fee is a massive drag on your day one capital. The property has to appreciate significantly just for you to break even on the initial friction of entering the trade.
That is the trade-off for the low barrier to entry. They have to make their money somewhere.
Yeah.
Now, moving up the complexity ladder, you have platforms like DiversiFund. They target long-term multifamily value-add projects.
Value-add meaning they buy an old apartment complex and fix it up.
Exactly. And they utilize a preferred return structure, typically around 7%. This means the limited partners, the retail investors like us, are entitled to the first 7% of the cash flow before the sponsor takes their cut of the upside.
That sounds pretty good.
It does, but the critical constraint here is illiquidity. These are closed-end funds with lockup periods extending 5 to 7 years. There is no secondary market. Your capital is entirely captive until the sponsor decides to execute a liquidity event like refinancing the building or selling it.
I would actually argue that illiquidity is the defining risk of this entire sector.
Hmm.
If you suffer a personal financial shock like you lose your job and you need to liquidate your position in that multifamily syndication in year 3 of a 7-year hold,
Yeah.
simply can't.
You're stuck. Which is why these investments are strictly for capital you absolutely do not need in the near term. Now, for the accredited investor, those who meet the higher SEC thresholds for net worth or income, the platforms offer access to far more sophisticated assets. First National Realty Partners, or FNRP, is a good example. They command higher minimums, often around $50,000.
50 grand. Okay, so playing with bigger money now.
Right, and they focus on necessity-based, grocery-anchored retail.
Meaning a shopping center with a supermarket.
Yes. The underwriting thesis here relies on the inelastic demand for essential goods. A shopping center anchored by a major national grocery chain is theoretically insulated against e-commerce disruption and economic downturns, because people always need food.
Right. And finally, for the advanced investor seeking tax engineering, the sources brought up 1031 crowdfunding. They utilize Delaware statutory trusts, or DSTs. And the mechanics of a DST are fascinating because it solves the biggest headache of a traditional 1031 exchange, the ticking clock.
Let's explain that because it's a huge benefit. A standard 1031 exchange allows you to defer massive capital gains taxes when you sell an investment property, but only if you roll the proceeds into a quote-unquote like-kind property.
But the IRS gives you a brutal 45-day window to identify that replacement asset, right?
Exactly. It's incredibly stressful. But a DST is a legally recognized trust that holds title to institutional-grade real estate. By investing your proceeds into a DST, you purchase a fractional beneficial interest. It perfectly satisfies the IRS like-kind requirement, immediately defers your capital gains tax liability, and completely removes you from all active management. It is the ultimate passive maneuver for advanced investors.
It is incredible how technology has managed to fractionalize a physical shopping mall into a digital security you can buy from your phone. But that same technology has birthed entirely new alternative asset classes with incredibly high yields.
If you can stomach the risk.
Exactly. This brings us to Section 4, Alternative Assets. We are exploring the fringe of passive income where high interest rates live alongside really unique platform risks. Let's dissect peer-to-peer or P2P lending.
Bankrate, along with international platforms like Mintos and LenderMarket, really outline this P2P landscape well. Bankrate also notes Prosper and Upstart in the U.S. The premise here is disintermediation.
Cutting out the banks.
Right. You are bypassing the traditional banking system to lend your capital directly to consumers or small businesses. In exchange for taking on that unsecured credit risk, you can capture fixed return rates anywhere between 8% and 16%. Plus, the entry barriers are tiny, sometimes as little as 10 euros on the European platforms.
But wait, if I am funding a $5,000 personal loan for some stranger online to consolidate their credit card debt and they lose their job, my investment goes to zero. I mean, unsecured consumer debt is the first thing people stop paying during a recession.
Which is exactly why you cannot manually select individual loans. You'd get crushed. The platforms deploy auto-investing robots to hyper-fragment your capital. If you deposit $5,000, the algorithm might instantly diversify it across 500 different microloans. You are relying on the law of large numbers. Even if 5% of your borrowers default, the 12% yield on the remaining 95% still nets you a positive return.
Assuming the default rate doesn't suddenly spike due to a systemic economic recession.
Right, macro shocks are the big threat there.
And again, we run into the liquidity wall. A personal loan is a binding contract. You cannot easily pull your money out unless the platform has a secondary market.
And even then,
Yeah, even then, you might have to sell your loan at a steep discount, like a 5% haircut, just to find a buyer if you need cash fast.
which instantly vaporizes your accumulated yield.
Exactly. And the fringe gets even weirder when you look at Yield Street, which CRE Daily covered. They are offering retail investors the ability to crowdfund debt for alternative investments like fine art, legal litigation finance, meaning funding lawsuits, and even oil tankers.
It's wild.
And over in the digital realm, Mintos highlights the yield generated by crypto staking, earning regular rewards by locking up cryptocurrency to validate blockchain transactions.
Let's isolate crypto staking for a second because it is often misunderstood as simply earning interest in a bank. It is fundamentally different. In a proof-of-stake blockchain network, you are locking up your tokens into a smart contract to support the operational security of the network. The yield you receive is effectively compensation for providing that infrastructure.
Okay, but loaning money to strangers online, funding lawsuits, buying oil tankers, and locking up crypto. I mean, this sounds like a recipe for losing your shirt. How do we play this safely? What's the ultimate rule here?
The ultimate rule of alternatives is understanding the specific failure mechanics. Like you said, recessions heavily impact personal loan defaults. But with crypto, there's a deeply embedded risk called slashing.
So slash.
Yeah. If the validator node you have delegated your tokens to experiences downtime, or maliciously attempts to validate a fraudulent transaction, the network protocol automatically executes a slashing penalty, meaning you can wake up and find your principal structurally deleted from the blockchain because of a server error on a node you don't even control.
Wow. That is terrifying.
It is, which reinforces the mandate that alternative assets are strictly diversification plays. They are not main pillars of a portfolio. They belong at the absolute periphery.
Right. Okay, so up to this point, every strategy we have mapped out, from savings accounts to real estate to fine art, requires one vital ingredient: capital.
You need money to make money.
Usually, yes. But what if you are listening to this and thinking, I don't have $5,000 for a savings account or even $100 for fractional real estate? If you have zero capital, you are locked out of the financial markets. The only currency you have left to deploy is your own time and labor.
Sweat equity.
Exactly. You must use your sweat equity to build digital assets. This brings us to Section 5, the creator economy and digital products.
The transition from financial markets to the creator economy is a major theme across Coursera, Equentis, and Bankrate. The objective here is to generate passive income with zero initial funds by investing time, skills, and creativity upfront. You endure massive, uncompensated labor initially to construct a digital product that benefits from zero marginal cost of reproduction.
Let's explore the mechanics of that zero marginal cost because it's fascinating. If you build a physical widget, every new customer requires you to source more raw materials, pay for more manufacturing, and cover shipping. Your costs scale with your revenue. But if you author an ebook using Kindle Direct Publishing, or design printable worksheets to sell on Etsy or Teachers Pay Teachers, or engineer an online course for Skillshare or Coursera, the initial creation takes hundreds of hours. But the cost to deliver that product to the second customer, or the 2 millionth customer, is effectively zero.
The asset detaches from your time. Furthermore, the sources highlight the rise of algorithmic content ecosystems, specifically YouTube automation, like faceless channels using voiceovers and animations, and affiliate marketing.
Affiliate marketing is huge.
Right. You build SEO-optimized digital real estate or email lists that intercept search intent, you recommend a product, and you earn a 3 to 7% commission.
I like to use an analogy for this. This is basically like building a digital vending machine. You might spend 6 months constructing the machine, getting it working, and stocking it with products, but once you finally plug it into the internet, it dispenses products and collects money while you sleep.
It's a great concept, but I have to bring a heavy dose of reality here.
Uh-oh. Here comes the catch.
Yeah, the barrier to entry is so low that the platforms are completely choked with supply. You mentioned Kindle Direct Publishing. Amazon Kindle has over 4 million digital titles.
4 million?
If you write an ebook, Amazon takes 30% of your sales right off the top. And because the market is saturated, you cannot simply be the author. You have to act as the author and the marketer.
Which means fighting the algorithm.
Exactly. And to even get visibility, you are often forced into the freemium model.
Giving away free content to build a following.
Right. You give away your highest value content for free for years on social media, hoping to convert a tiny fraction into paying customers for your premium access. The customer acquisition cost, measured entirely in your time and energy, is astronomical. It requires a massive upfront time investment before a single dollar is ever earned. It's arguably the most active labor imaginable until it finally tips into being passive.
So if you don't have capital, and you frankly don't have the time to write a book or build a YouTube channel, there is a third option, and this is Section 6. It involves monetizing the idle physical items already sitting in your garage. We're calling this the idle asset economy, renting your life.
Both Mintos and Bankrate delve into this micro-rental market. The premise is turning non-income producing assets into cash-flowing mini businesses.
Because most of our stuff just sits around gathering dust, right?
Exactly.
Yeah.
Think about your power tools, lawn mowers, tents, coolers. They spend 95% of their life cycle depreciating. They are liabilities. The micro-rental platforms allow you to convert those liabilities into assets.
You can even rent out your parking space, especially if you live near a commuter hub or a stadium. And the sources also discuss the concept of wrapping your car in advertisements for passive income while just driving your normal daily route.
It's a really interesting space.
Here's where it gets really interesting for me, but also a bit sketchy. Advertising on my car. Renting out power tools to strangers. Isn't this just asking for lawsuits or getting completely scammed?
That is a very valid concern. Let's tackle the car wrapping first, because the sources specifically flag this. It has a remarkably high prevalence of fraudsters looking to bilk drivers.
How does the scam work?
The typical scam involves a fraudulent ad agency sending you an oversized cashier's check. They tell you to deposit it, keep a portion for yourself, and wire the remainder to their quote-unquote preferred decal installer. A week later, the original check bounces, the bank reverses the deposit, and the money you wired to the fake installer is gone. You must thoroughly vet the ad agency.
Wow. And what about renting out household items? If I rent out an industrial power drill and someone gets hurt, am I liable?
Liability is a massive concern. You cannot execute these transactions on a peer-to-peer handshake. You must utilize platforms that offer robust, institutional-grade insurance wrappers. And the contracts must explicitly require the renter to replace damaged goods.
So the platform protects you.
Right. But if navigated safely, there is a massive macro benefit here. This contributes heavily to the circular economy, directly reducing one-time use purchases and manufacturing waste.
That's a great point. But whether you are renting out a drill, buying an ETF, or crowdfunding a grocery store, the path to passive income is clearly littered with traps. Which brings us to our final section, the reality check. Let's look at how to avoid the major pitfalls and protect your newly built wealth.
REP Equity provides a brilliant distillation of the common mistakes that systematically destroy passive income portfolios. They outline 3 major traps.
Right, trap number 1.
Underestimating risk. The allure of easy money blinds people. Investors rarely calculate risk-adjusted returns. They chase the highest possible return rather than looking for stable yields. If you take on 300% more risk to capture a 5% higher yield, that is an asymmetrical trap.
Trap number 2, lacking diversification. And I want to raise a scenario here. What if I put all my money into like 20 different high-yield tech dividend stocks? I'm diversified across 20 companies, right?
No, that is the illusion of diversification. Those companies are all perfectly correlated. Sector-specific downturns, like a semiconductor shortage or regulatory crackdown on tech, can wipe out all 20 of your income streams simultaneously. You need uncorrelated income streams. For example, mixing real estate with municipal bonds. If equities crash, your real estate cash flow is insulated.
Got it. And trap number 3.
Insufficient due diligence. You simply cannot trust marketing materials at face value.
So what's the actionable advice here? How do we vet this stuff?
When looking at real estate syndications or alternative platforms, you must vet the sponsor's track record. Have they survived a recession? You need to read the financial statements yourself, calculate the net operating income, the NOI, and look for third-party verification. And crucially, you have to understand your taxes.
Taxes will eat you alive if you're not careful.
Exactly. Per annum points out tools like India's Section 24B for home loan interest deductions. You have to utilize tax codes to maximize what actually stays in your pocket. The gross yield doesn't matter. Only the net yield matters.
Man, what a journey. Let's quickly recap what we've covered today. We started with the safety of high-yield savings and money market accounts. We moved into the compounding geometry of dividend stocks and bond ladders. We dissected the complex math and fractional platforms of real estate crowdfunding. We looked at the extreme risks of P2P lending and crypto staking, and finally, the sweat equity required to build digital vending machines and the liability of renting out idle assets.
It's an incredibly dense ecosystem, but I want to leave the listener with a final, provocative thought to mull over.
Lay it on us.
If passive income models, like fractional real estate and automated digital products, continue to explode at a projected 45% annual growth rate, are we approaching a future where the traditional 9-to-5 active income job becomes the secondary side hustle?
Wait, really? The job becomes the side hustle.
Think about it. With automation handling the friction, your passive portfolio could become your primary career, and your active labor is just the side gig you use to fuel it.
That is a complete inversion of how society views work and wealth. I love that concept. Well, thank you for joining us on this deep dive. We encourage you to pick one pathway discussed today, analyze your own specific mix of capital and time, and take the first step toward building your own financial orchard.